Hello everyone, this video is an investment case analysis about the Gentex Corporation. Firstly, I want to make clear that this analysis is not any kind of recommendation to buy or sell any financial product related to the company. This video is for informational purposes and is based on a personal opinion not linked to the company. I currently have no positions in this company, but I could buy shares at any time or in the near future. Each investor has to carry out his own study of the company and must be responsible for an investment. The analysis is divided into several sections that we will see one by one. We will start with an overview of several key points. To continue analyzing the business in a little more detail over time and today. We will see the markets and competitors. Next, we will see the details about the management, the current situation, and historical evolution of the financial data, as well as the guidance for 2021, the risk, and finally the estimated valuation. So let's get started with the overview. Gentex is a company classified in the automotive sector, particularly in the auto parts and equipment industry. But as we'll see later, it could also be considered a tech company. It's a leading supplier of advanced electronic products for the automotive industry worldwide. The company's largest business is patented auto-dimming mirror technology with 93% market share. The main competitive advantage comes from the 7% annual investment in research and development. The business has sustained an organic growth of 10% over time, the highest margins in the sector. There is no debt and experienced management with good performance and aligned with the shareholder interest. Its price on the stock market has been multiplied by more than 200 times in the last 30 years. And in my opinion, it is currently trading at a fair price, but seems to be a good idea to keep on the watching list for the next entry opportunity that MARQUEZ sure will offer. On this slide, the company summarized core competencies, number of employees, patents, global distribution of sales and logistics centers, etc. Patents are another source of competitive advantage, growing in number year after year. Later, we will comment the evolution of employee number that has a growing trend except the crisis years like the 2020. Let's look at the business a little more in detail, but first let's see its historical evolution. The company was founded in Michigan in 1974, initially producing smoke detectors. 6 years later, it entered the interior rear view mirror market, innovating with the electromechanical auto-dimming, where has been strongly positioned over the last 3 decades. Starting in 2010, it began to manufacture electrochromic dimmable aircraft windows and made acquisitions of companies such as HomeLink, which increased integrated products within the rear view mirror business. In the last 5 years, the number of innovative products can be integrated into the car has continued to increase, as well as the development of products for another sectors, such as the airline, chemical, and medical industries. Currently, the main activity of the company is to design, develop, manufacture, sell, and supply digital vision, connected car, dimmable glass, and fire protection products worldwide. But it has 98% sales concentration on rear view mirrors. This concentration risk is what the company intends to mitigate by opening up the other business lines and promote them. The main product groups are vision systems, dimmable devices, and connectivity and sensing. As mentioned in the previous slide, the company intends to improve its market leadership in dimming technology, accelerating growth in new markets. Competitive advantage are focused on cutting-edge technology and product quality. Regarding vision systems, they also want to continue growing in emerging markets as well as evolve digital products in current markets. The acquisition of HomeLink combined with cloud-based technology is making possible to offer products that links the car with homes. Another interesting advantage is the security in the car. iBiometrics is being used as a car key, looking at the rear view mirror. This method is more accurate in biometrics, reaching a precision of more than 90%, while others like fingerprint is around 70%. Now let's have a look at the market, customers, competitors, and a comparison with different metrics. As we have seen, the main sector is the automotive, in particular the worldwide sale of latest rear-view mirror generation, including the technological advances such as biometric authentication, exterior digital vision from all angles, interior monitoring, which includes a system that warns if the driver falls asleep, for example, and many more extras based on the latest technologies. Customers, as we can see, are the main worldwide automotive manufacturers. 5 of them concentrate more than 50% of the sales, and each one more than 10%. This represents clearly a risk that if any of them get in troubles, it'll have a relevant impact for the company. Specialization in particular sector is a risk, but it's a good side. It has a good side. The specific development of this type of product has allowed to be the world's leading company with a market share over 93%, as I said. It has no comparable rival but Magna International's mirror division, which covers the rest of the market alongside with small Chinese and Japanese companies. The dimmable aircraft windows market has had a high impact by the COVID-19 pandemic, but the company continues to develop this market where there are no competitors at the moment because it is an innovative product. The clients are the Boeing Airbus duopoly. Fire protection products is the oldest division, small compared to the automotive one. Its main market is the United States, where it has numerous competitors. The company believes that the technological advances of nanofibers will allow them to increase market share. With the acquisition of Vaporsens, they intend to increase the research and development in the nanofiber field, in addition to all these divisions that we have seen. The last one, which is in the development phase, is the partnership with the Mayo Clinic for development of vision system and technologies related to the healthcare equipment technologies. Now let's see the comparison of following margins and ratios with the most relevant companies in the industry. The gross profit is clearly higher, 30 to 35% last 25 years. Meanwhile, the rest of the company is 15% on average. Also stable over time. The net income follows a similar trend, being 20% against 5% on average for the rest, highlighting in both cases a descending peak of the margins in the 2008 crisis for the entire sector. The same trends for the EBIT and EBITDA margins, where Gentex has 25% EBIT and 30% EBITDA on average over the last 25 years, while the industry average is half or less in both cases. The free cash flow margin also has the same trend, but with greater volatility as the rest of the industry. The lowest peak in 2012 is related to the acquisition of HomeLink for approximately $700 million, where 275 were financed with debt issuance and the rest paid down in cash. The return on equity, the same thing, but Aptiv has a higher margin. However, Aptiv has $4 billion debt, which is 50% of the equity, and Gentex has no debt. As for the return on assets, it is once again the largest margin by far and stable over time. The return on total capital, Gentex has has been above the industry average, and now as well, despite the general decline of the margin in the industry. Historically, the average price earnings ratio of the company has been 17. In the last 5 years, more than 20. In fact, it is now trading at 25 times earnings. It seems to be overpriced, but considering the market is trading at 22 and the industry at 26, considering the quality of the company, it seems like a fair price at this point. The historical average of the enterprise value EBITDA ratio has been 9 times, always above the industry average. The current comparison with the industry is the same, because all have raised this ratio. But the market and the industry in particular may be overvalued in general. The enterprise value to sales ratio, currently 5 times. It has a historical average of 3, always above its peers. Despite this high ratio, it is still far from the threshold of 10 times that we consider the limit in the case of investment. The price to book is currently 4 times versus 3 times historical average, and it is usually more or less in the sector average. In these two plots of different time periods, we can see in both cases that is one of the best performances in the medium term and the best in the long term. We can also observe that it's a compounder with compounded annual growth rate historical of 9% and approximately 20% in the last 5 years, dividends not included. Now, let's get to know the management. Gentex has an experienced management team, both in the sector and in the company itself. They work for the company about 15 years and 3 in the position they currently hold. Although they don't have a high percentage of shares, they all have more than 1 million in shares, and the CEO have about $5 million. Their compensation is aligned with the performance of the company, and they have moderate salaries. Altogether, with the good capital allocation they do, makes them a good managed team. Here we can see their LinkedIn profiles, where the experience and position developed all these years are detailed. They are 45 years old on average, which also offer a significant margin of time to continue developing the good work they do. As indicated in the previous slide, they have and will have a moderate salary compared to companies of the same size in the market. And the main metrics for the bonus will be aligned with the company's performance: revenue, operating income, and earnings per diluted share. The corporate culture is oriented to quality and innovation, and tries to retain talent. And it is frequently named among the best companies to work for. The management treat the shareholders well by making a good capital allocation, investing in what creates value, or paying dividends to shareholders. The management has a low ownership percentage, as we saw, while the institution owns the largest shareholder. But it seems to be normal in the industry, because even though it's not a good thing for a small investor, it seems to be normal in the industry because the ownership breakdown is quite similar to the rest of the companies in the industry. Taking a look at the numbers, we will check if they are correlated with the narrative. First, using the Morningstar key metrics for the last 10 years, we can see that except for the last year, it has grown in sales and earnings per share year after year. The gross and operating margins are high and stable, and as we saw in the comparison with the market. The shareholders have not been diluted, bought back 15% of the shares, in fact. In this period of time, the book value has gone up from 3.41 to 7.78. The CapEx has been in the 50 to 120 million range, having decreased in recent years to 52 million. The company foresees this year a CapEx around $85 million, and the free cash flow follows the same growing trend as profits and revenues. The working capital has an average of 750 million. In recent years has been reduced from 1,000 to $800 million. In this slide, in addition to seeing the margins that we already know and the evolution, we see an important fact commented in the summary, which is 7% of average spending on research and development. In terms of profitability, we can see that the margins are high, and the stability of all ratios except the last year as a result of the COVID-19 impact. The margin of free cash flow over revenues has been increasing year after year, currently being 24%. In terms of financial health, as mentioned before, the company has no debt and has no liquidity problems. In terms of efficiency, like other figures of the company, we can see that it has been very stable except for the last year, where all of them have gotten worse in the last year. A very solid and a stable balance sheet, where current assets represent 44% of the total asset and current liabilities are 8%. Almost 90% of the assets are financed with equity. Only 10% correspond to liabilities and are basically accounts payable and accrued liabilities. We are going to insist a little more on the financial statements, going back in time to the 2008 crisis to see the behavior of the company during and after that year, and trying to guess what we can expect in the current crisis. The drop in sales was significant during 2008 and 2009, but operating margins were quite resilient. Although the profit fell by half, it continued paying dividends to the shareholder and investing in R&D, having a strong recovery in 2010, exceeding the levels of 2007. The fact of having a net cash of 400 million, as in 2007, will let us think that they won't have financial tension in facing this crisis. The number of employees has been affected as in the previous crisis. The company has reduced the number of full-time employees by 10%, while in 2008 was about 16%. Despite this specific reduction from 2,300 to 5,800 from 2009 to 2019 in the last decade. So, as we show it in the same look, is the same looking back with capital allocation. The same for the rest of the metrics that we have seen. Significant impact in depression, but great resilience to continue to recover relatively quickly. Maybe this slide from Simply Wall Street makes a clearer picture of Gentex solvency with a very solid balance sheet. Despite this difficulty represented by the uncertainty of the evolution of the pandemic, let's see what predictions are made by both the company and the market analyst. According to the company and the vehicle production forecast, revenues for this year could be between $1.94 and $2 billion, which will be which means returning to a full recovery, returning to growth, basically. Gentex has, as we saw, has a 93% market share currently in the DIME in rear view mirrors, which means that an increase in the overall market, as expected, will help the companies continue growing. And as indicated here, an improvement in the vehicle sales is expected worldwide. The 7% annual expenditure on R&D improves the competitive advantages of the company. One thing I like about the company is that it does not expect competition to harass it to create better products. The fact of competing against itself places the company at the cutting edge technology and makes the moat remain or expand like they did. This has been the case in recent years, raising the market shares to 87% to 93% in recent years. The company plans to continue advancing to non-automotive divisions. The gross margin for 2021 is expected to be around 40%, which is the highest in the company history. A structural cost reduction will help improve these margins. Operating expenses will be in line with 2020, where they were 205 million, and this year will be 210, 220, more or less. The CapEx will go from 55 million to approximately 90 million, mainly due to production equipment purchases. Depreciation and amortization will remain at 100 million, more or less, as the previous year. The company indicates that the tax rate will be approximately 17%. The detail of the authorization of the repurchasing shares program is interesting, which will be effective as long as it creates value. Market analysis forecast for Gentex for the next 3 years in terms of return on equity is 24%, almost double that forecast for the industry. The annual growth for both revenues and earnings are around 10%, that historically has had on average. And below we see a prediction of EPS as well as revenues, earnings, and cash flow. In a rough way, we see how by 2026 the EPS should be, or they expect to be, $3 per share. If the price earnings ratio were at the current level, we will be talking about an estimated value of $75. And if it were the average historical pair of 17, we will be talking about $51. In any case, in the valuation section, we will go into detail in different hypotheses. The risks that I consider most relevant are the following. Although having 93% of the market share is a very positive fact, the company's sales being 98% concentrated in a single sector, and this sector specifically, that is a cyclical one, it would be preferable to have it more diversified, and it seems to be that they are working hard on it. In addition to the concentration in one sector, 50% of the sales are also concentrated in 5 clients, which means that any structural problem or of any of them will have a relevant impact on the sales of Gentex. Price pressures and the US geopolitical environment with other jurisdictions is something they are dealing with historically. Although we have compared the company with others in the same industry, it really only has one direct relevant competitor that is a division of Magna, and between them they practically dominate the market, as we saw before. There is a technological risk using mirrors with digital vision, that is, they can't stop working due to a technical problem. Here, the company has gone ahead, making possible to turn off and function as a traditional rear view mirror in such a way the driver never lose vision. But repeated failures in any product could cause reputational damage that could affect the accounts. Although it does not have a financial risk on its own, it does have to pay attention to the financial stresses that it might detect in some clients due to this crisis. Finally, in addition to macroeconomic factors in a cyclical sector, the impact of the pandemic cannot be accurately predicted. And now we come to the last part, the estimated valuation, taking into account the narrative and the numbers that we have seen in the presentation. The first estimation we are going to see is based on projected free cash flow using the following hypothesis. Growth revenues of 10%, which is the historical average and the analyst forecasting as well. That means 1.8 billion for the first year, which is 200 million less than the company guidance. 23% free cash flow margin, which is the last 5 years average. Discount rate of 9% and a perpetual growth of 2% after the next 5 years. Then we can map to an intrinsic value of $33. And it's quite similar than that is currently trading, which is about $35 or $36 today, I think. Using the analyst consensus forecasting about EBITDA, EBIT, net income, free cash flow, and book value, we are going to see two scenarios. First one, the estimation with the current multiples and 2 periods, 3 years and 5 years. The estimation will be in those cases $50 and $61 on average, respectively. The second scenario, the same estimations with the historical average multiples, would be 33 and 40. And on the right side, we have the internal rate of return. Sorry, I wrote it in Spanish here. It does not include the dividends that yields 1.33%. A valuation of the same type, but with my own hypothesis, the compounded annual revenues growth for the next 5 years fixed at 10%, in line with the historical and being more conservative for the first years than the company's guidance. On the other hand, it must be said that the company usually beats the market forecast. Regarding the EBIT, I use the historical average for the last 17 years. I also consider 30% as a tax rate, which is double than the company expects to pay this year. This represents a variance of $4 or $5 less in my estimated price. In the first scenario, with the current multiples as the previous estimation, the value is between $45 and $55 for the 3 and 5 years, respectively. And in the scenario of the average historical multiples, we will be talking about $30 and $36, respectively. As we have seen in the valuation, the hypotheses have a great impact in the results, as we have seen valuation from $30 to $60 so far. Now it is currently trading at 36 exactly. It seems that the downside is limited in the least favorable case. It is reasonable to think that based on the numbers and narrative, the company could earn about $3 per share in 5-6 years. And if we apply the historical multiple, as I said before, using 17, we will be talking about $51. In this slide, I just built a ranking with the best companies of the industry. I have ordered these companies as many times as features we have on the right side, each time giving points based on their order, and finally using the total points to make the last ranking as we can see it on the left, which means Gentex is the best on average for each single ranking built with each metric. This ranking verifies that we have what we have seen in the market section when we have compared it with its peers. These are the results I have found after build several machine learning models like XGBoost, neural networks, supported vector machine, decision trees, gradient boosting, and some others, using trimestral financial statements since 2011, ratios, daily prices, moving average in different periods, etc., analyzing more than 130 features, and ending up to a random forest model that offers these results and predictions. The target value has been to decide if a given price is going to be 10% higher in 1 year, later, or lower. Using a test out of sample, if we bought the company shares when the model recommends, which means 183 out of 184 times we were right, which means 99% of precision. For example, if we had purchased from the 2nd until 8th of April 2020, the return had been between 51 and 74%. Now, if we try to predict with the data of the last week of March, the model tells us that the company's price won't be 10% higher. Also, the model results tell us that in this case, the precision will be 84% instead of 99% because the model is optimized for the purchasing case. On the right side, we can see the model variables importance ranking. Finally, we see what Gentex is indeed a historical compounder. Its price has been multiplied by more than 200 times since inception, and given its volatility, it offers entry opportunities from time to time. So I will keep it on the watch list. I hope you like it. You can click below, subscribe the channel. Also, you can let your comments below. Regards and good investment.